The US-Israel versus Iran conflict. What it means for markets opening. Hook. When geopolitics escalates, markets react almost instantly. In the past few days, tensions between United States, Israel, and Iran have intensified following coordinated military strikes and retaliation across the Middle East. Almost immediately, global markets responded. Oil surged, stocks turned volatile, gold rallied, and investors around the world started asking the same question: how does a geopolitical conflict translate into financial market movements? To understand that, we need to look at three things: energy supply, market psychology, and global economic expectations. 1. Why markets react so fast to geopolitical conflicts. Financial markets are essentially machines that price future uncertainty. When a major geopolitical event happens, investors immediately begin reassessing risk. A conflict involving Iran is especially sensitive for markets because of where Iran is located. Iran sits next to the Strait of Hormuz, one of the most important energy shipping routes in the world. Around 20% of the world's oil supply passes through this narrow waterway every day. That means even a small disruption in this region can quickly affect global energy prices. When traders see rising geopolitical risk in the region, they begin pricing in the possibility that oil supply could be disrupted. And that's exactly what we are seeing now. Oil prices have surged sharply as markets price in the risk of supply interruptions and shipping disruptions in the Persian Gulf. But the impact of rising oil prices goes far beyond energy markets. 2. Why oil prices are the first market to react. Whenever conflict emerges in the Middle East, oil is usually the first market to move. That's because oil markets react not only to actual supply shortages, but also to risk premiums. In other words, traders begin adding a geopolitical risk price into oil even before supply disruptions happen. Recent reports suggest that markets are already pricing in a significant risk premium because of the conflict. In extreme scenarios, analysts warn that oil prices could rise dramatically if the conflict continues or spreads to energy infrastructure. Why does that matter? Because oil is one of the most important inputs in the global economy. It affects transportation, manufacturing, shipping, airlines, food production, and even electricity generation in some regions. When oil prices rise quickly, the effects spread across the entire economic system, and that's where financial markets start reacting. 3. The chain reaction in financial markets. When oil rises sharply, it often triggers a chain reaction across multiple asset classes. Let's break down the typical pattern. First, stock markets become volatile. Higher energy prices increase costs for companies and reduce profit margins. Recent trading sessions have already seen stock markets decline as investors reacted to rising oil and uncertainty. Second, inflation expectations increase. Energy prices are a major component of inflation. If oil remains high for a prolonged period, it can push inflation higher globally. That creates a difficult situation for central banks. Many central banks were already navigating the delicate balance between controlling inflation and supporting economic growth. A sudden oil shock complicates that balance. Third, investors start moving towards safe haven assets. Historically, assets like gold, government bonds, and the US dollar tend to attract capital during periods of geopolitical stress. Gold prices, for example, often rise when global uncertainty increases. This is because investors are seeking assets that historically hold value during crises. 4. Why energy markets matter more than the conflict itself. One important insight often gets missed in media coverage. Markets are not reacting to the war itself. They are reacting to what the war might disrupt. In this case, the key concern is global energy supply. If the conflict spreads across the region or begins affecting oil infrastructure, shipping routes, or tanker traffic, the consequences could be far larger than the immediate military events. For example, reports suggest tanker traffic through the Persian Gulf has already slowed due to security concerns. Even the perception of risk can cause shipping companies and insurers to raise costs or reroute ships. That increases transportation costs and tightens supply. And when supply becomes uncertain, prices rise. 5. The global economic implications. If energy prices remain elevated for an extended period, the global economy could face several challenges. First is inflation pressure. Energy prices directly influence inflation across economies. Higher oil prices make transportation, manufacturing, and logistics more expensive. Second is slower economic growth. Higher energy costs reduce consumer purchasing power and increase business costs. That combination can slow economic activity. Third is policy uncertainty. Central banks such as the Federal Reserve and the European Central Bank may need to reassess their interest rate policies if inflation rises again. Markets closely watch these policy shifts because interest rates affect everything from stock valuations to borrowing costs. 6. How different markets typically react. Let's look at how different financial markets historically respond during geopolitical crises. Oil markets usually rise quickly because supply disruptions are possible. Stock markets often become volatile in the short term as investors reassess risk. Gold tends to rally as investors move toward perceived safety. Currencies, safe haven currencies, particularly the US dollar, often strengthen. Cryptocurrency crypto can be unpredictable. Sometimes it behaves like a risk asset, falling with stocks, while other times it moves independently. In the early phase of geopolitical events, markets are primarily reacting to headlines. But over time, they begin focusing more on economic consequences rather than political events. 7. What history tells us. Geopolitical shocks are not new to financial markets. Over the past several decades, markets have navigated events such as the Gulf War, the Iraq War, and more recently, the Russia-Ukraine War. In most cases, markets experience short-term volatility, but over longer periods, the direction of markets tends to depend more on economic fundamentals than geopolitical headlines. That's why many analysts focus less on the immediate market reaction and more on whether the conflict disrupts energy supply or global trade. Those are the factors that have lasting economic impact. 8. The key variable markets are watching. Right now, markets are watching one thing above everything else: the stability of the Strait of Hormuz. If oil continues to flow through this corridor without major disruption, markets may eventually stabilize. But if shipping routes become blocked or energy infrastructure is damaged, the economic consequences could become much larger. Energy markets will likely remain the primary indicator of how investors assess this risk, because oil prices often tell the story before other markets fully react. Closing geopolitical conflicts create uncertainty, and uncertainty is something financial markets dislike. But markets also adapt quickly. They constantly reassess information, adjust expectations, and price risk accordingly. So while headlines may focus on military events, financial markets are watching something different: energy supply, inflation risk, and the broader impact on the global economy. Because in the end, markets are not trying to predict wars. They are trying to price the future.